And before we go to the case studies, I've also summarized the, the provisions of the law and how the structure of the FEMA is and how these provisions of the FEMA are trying to regulate the transactions of the residents as well as the non-residents. Can you please go to the next slide, please? So in last 10 years, you will notice that most of the provisions from section 1 to 49 have been intact and they were amended through the various notifications of the capital account transactions and the current account rules. What we find only one change in so many years is the change which is made out in 2015 by virtue of amending section 62, 63 and 37 and 46, whereby two things took place. One is the power to regulate the capital account transactions was given away to central government. And the second change was made by virtue of introduction of section 37A, whereby criminal powers were given to the enforcement directorate that if you found in contravening any of the provision in relation to the foreign currency, foreign properties, and foreign securities are owned in contravention of the act, then you may be punished, including the imprisonment. With this background, let me go to the next slides. Can you please take it to slide number 25?
Kirit, can you mute all the other participants because we could hear some prayer in the background?
By default, they are muted only.
Now, sir, as you all know, there are four important definitions under FEMA, which are important for the purpose of understanding the transaction of FEMA. The first two definitions are the capital account transaction and the current account transaction. And the next two definitions are the residency status, being a resident under FEMA or a non-resident under FEMA. Why these four definitions are important? Just to recap the objective of the FEMA provision and the law, that it is regulating the transaction of resident as well as non-resident in India as well as outside India. Largely, you will notice that prospectively, you will find that the law is designed for non-resident or for resident to control or to manage the foreign exchanges in India. However, you will find that the large portion of the act is revolving around the capital account transaction and current account transaction, whereas non-residents are affected only for the purpose of capital account transaction, and residents are affected by current account transaction as well as the capital account transaction, and therefore it is affecting the residents largely as compared to the non-residents.
Just got into webinar. Tell me, madam.
Now, therefore, two transactions, capital account transaction, current account transaction, we all know how they are defined. That the current account transactions are one, which are not a capital account transactions. And capital account transactions are such whereby assets of the residents are altered outside India, as well as liabilities of the residents are altered outside India, or the assets and liabilities, including contingent liabilities of non-residents, are altered in India. So if such an alteration of the assets or liabilities takes place, then it is called a capital account transaction. And if such changes do not take place, then they are called as the current account transactions. So when a individual client or a company approaches in day-to-day practice, they come out with the various questions. So what will happen on a day-to-day basis? That either non-resident or a resident will approach you for their transactions. Now, what are those transactions? As you can see in this slide, that person resident in India, that is resident, can either come up with current account transactions issues or a capital account transaction issues. And the non-resident will come out most probably for a capital account transaction to be considered in India. Because if there is a transaction to be carried out outside India, probably he will not approach you. The other two important, three more aspects which are arising out of day-to-day practice is once a resident or a non-resident approaches you, then they will talk about, I think, either the two transactions, but the three important aspect is that how these transactions are to be carried out is referred in section 3. That these transactions are to be carried out only in the manner in which it is specified in section 3, that most of the transactions are to be routed through the authorized dealer. This is provided because there is no other mechanism for the Reserve Bank of India to record and understand this transaction in a manner after the transaction is carried out, or to find out a suspicious transaction after the transaction is carried out, unless it is carried out through a authorized dealer. So therefore, section 3, we may popularly call it as a Hawala transaction, but I would try to understand that it is a mechanism through which the transactions are to be carried out. There are three matters. One is the section 3 of the FEMA, and the two other exceptions are the liberalized remittance scheme and the remittance scheme. Why there are exceptions to the rule? Because most of the capital account transactions are specified in the manner in which it is required to be done in the notification itself. However, if the conditions of the notifications are restrictive, then those restrictive conditions will normally not apply under the liberalized remittance scheme or under the remittance scheme for the non-resident. So these are the two important aspects which we must keep it in mind when we read the notification with the restrictive provisions of this particular notification. Now, coming to the next slide. That how, next slide please. That how we will approach the problems of resident as well as non-resident. When we want to respond to the questions of resident and non-resident, we will understand the transaction. If the transaction is current account transaction, then we will resolve it through a regulation relating to current account transaction. And if the transactions are capital account transaction, that could be either government route or the Reserve Bank route. So in those cases, we will have to find solution from the RBI route or the government route, and that's the solution we have to come to conclusion. So we go to the next slides on the case study number 1 on slide number 35. Paragraph 35, please. Yes, please. this is a case study where Mr. Lewis, who's an Indian citizen, is required to pursue his deputation to UK. He is a managing director or a chief executive of an Indian company. An Indian company has a business on a global basis, and therefore, Indian company is considering whether Mr. Lewis can be relocated to the UK. What if we are told that Mr. Lewis is likely to be occupied for 100 days in UK and about 120 to 180 days in India, and rest of the time he may be required to be outside UK as well as India. We are also told that Mr. Lewis has a income more than 50 lakhs in India, and he want to migrate with his family, and also he is looking for making investment outside India in his properties and other businesses to pursue this opportunity which has been offered to him by his company. So Mr. Lewis has approached the BCA study circle to understand as to how he can consider this opportunity of migration to UK under the provisions of the FEMA as well as the provision of the tax law. Okay. So therefore, in order to understand the provisions of the law, we all know that there are two types of residency status, one under the FEMA and one under the income tax law. Now, when you think that Mr. Lewis has to be relocated to outside India and into an UK, then FEMA does permit you for the purpose of deputation that it be treated as an employment abroad. And from the time he takes up his employment, he may be regarded as a non-resident under FEMA. Now, coming to the taxation, we are all aware that Mr. Lewis, if he is able to consider physical stay in India in accordance with Section 6 and 6, then he could be considered as resident or a non-resident, depending on the circumstances and the employment conditions and the tax status outside India. We are mainly concerned with the explanation B to Section 6.1, which is now introduced. And it says that, particularly in the later part of the explanation, that if he stays in India more than 119 days in a year, and if his income is exceeding 15 lakhs, then he will still be regarded as a resident in India. Also, the explanation 1A says that if he is not a resident, tax resident of any other country, then also he will be regarded as resident in India. So Mr. Lewis is concerned about this particular two provisions, whereby if he stays 100 days in India, 100 days in UK, 120 to 40 days in India, and rest of the time outside the two countries, then probably he would be regarded as resident in India. Of course, the later provision, section 66, which is also amended, it says that if there are individuals, citizens of India, who are resident under the explanation B or under explanation 1A to section 6.1, then in such a case, both will be treated as resident but not ordinary resident. Can we go to next slide, please? Next, please. Next, please. there is a slide 42. Please go to 42. Yes. See, I have put up this provision which are newly inserted in the definition of resident under section 6. That the main difficulty for Mr. Lewis is the explanation B to section 6.1, whereby his income is more than 15 lakhs in India and his stay is also more than 119 days in India, which makes him not ordinary resident in India. Also, if he is not likely to be a tax resident in UK, he could be regarded as again resident under the explanation 1A. And finally, he could therefore be rated as NOR. What we can advise as the right member of the study circle was the proposition. Probably when my stay exceeds 190 days in India for Mr. Lewis, there are situations where by virtue of my stay of 120 days or 100 days in UK, Mr. Lewis could be regarded as resident of UK under certain circumstances of owning a dwelling house. So could be advised, Mr. Lewis could be advised that yes, if you are taking up an employment in UK and if you are regarded as tax resident in UK, probably one can advise as to the treaty provisions for Mr. Lewis comes to his rescue. What are those treaty provisions? That we have India-UK tax treaties whereby Mr. Lewis can access the India-UK tax treaty for the purpose of tiebreaker test of Article 4. What is the tiebreaker test? As you all know, that if Mr. Lewis can be regarded as resident of UK and he is also a resident of India under this explanation B, then in such a case, tiebreaker test will be in favor of Mr. Lewis and in favor of UK because he is migrating with his families. He is likely to make large investments outside India and his job is not up for a fixed period. And therefore, it is possible that he will resolve the tax treaty issues in favor of the UK, and therefore the 119 days test or staying more than 120 days in India may not apply to him. Now let us try, because for the same reason, even 6.1, even explanation 1A will not apply because now he is a resident of UK and therefore explanation 1A will also not apply. It can be further argued if this particular contention has some drawback, then it can further be argued that since I'm a resident of UK, definitely explanation 1A does not apply. And also explanation B to section 6.1 also does not apply because the resident of both the country probably while accessing the tax treaty can possibly argue that the tiebreaker test requires me to consider the definition of resident status of both the tax law. Those definitions which are based out of the criterion of domicile or a stay or such similar criterion, but it should not consider any criterion which are based on the location of income or a source of income or a capital in that particular domestic state. Can we then argue saying that since definition, particularly explanation B and explanation 1A, talks about the residential status purely based on the income exceeding 15 lakhs. And therefore, both the portion, that explanation B later part of exceeding 15 days and stay between 120 and 81 days, and 61A, which is purely based on the income. Of course, I have a residency status in UK, but purely on income. Can we say that we will ignore for the purpose of tax treaty that definition which treats me a resident of other country purely based on income? So possibly that could also be an argument in favor of Mr. Lewis if you want to consider that he should be liable to tax in UK on a worldwide basis also. Coming to the next slide. So therefore, what will happen, let us say if both these arguments do not work in favor of Mr. Lewis and he is regarded as NOR in India. Probably if he's been treated as NOR under section 6(6) of the Income Tax Act, then we can advise him that yes, the scope of income under section 5(2) for non-resident is same as that of residents, as well as certain income earned outside India, accrued outside India from the business control in or from the profession set up in India. So that's only the dark side of the status of NOR. Also, I would like to think that if he were to turn to be NOR and these arguments do not work, then probably most of the provisions which are applicable to non-resident in the IT Act will not be applicable to him, which will take away number of concessional tax treatment income as resident and not as a non-resident. For example, the income from a dividend, which would have entitled him India-UK tax treaty, and the dividend income could have been taxed at lower than 30% rate. Then various provisions of the law which are a presumptive basis taxed will not apply to him. And income from fees for technical services, other items of income like interest, which is also taxed at a concessional rate of 10 and 20, will also not apply to him. This is the darker side rather than the scope of income, which is included in 5(2), according to me. So with that, I think we can definitely advise Mr. Lewis so as to say that whether you can take employment in UK or in any other jurisdiction which is a tax haven. Also, lastly, I would like to touch upon that exempt income which are based on purely the residential status under FEMA will not make any difference if Mr. Lewis were to turn to NOR. So with that last point, probably we can say, Mr. Lewis, with a little bit of sanitization, that yes, it is possible for you to consider the residency status in UK and probably avoid taking employment in anywhere else where you are not able to prove your tax resident status, either in Jersey or any other tax haven. And with that background, we can easily or safely advise him to be a non-resident under FEMA, as well as he can consider this advice to relocate himself to UK and be tax resident in UK and pay taxes in UK on the basis of the criteria of 91 days stay in the dwelling house or any other criteria under the domestic law of the UK, by considering the background of the tax treaty, the Article 4 tiebreaker test, and the ignorance of the income-based condition under the tiebreaker test, or in any case, since he is a tax resident of UK, there should not be any difficulties in arriving at that conclusion. Can we go to case study 2, please? In any questions on case study 1, we can take it up now for a few minutes. Parag, any question?
Yes, I'm very much.
If anybody want to ask any question, can unmute themselves and ask the question.
But Kirit, is it audible properly? Everything?
Absolutely, absolutely, super.
Hello.
Very clear. Yes. Yes, please, Basant, give your name and.
Sir, sir, my name is Basant Porwal. I'm from Pune.
Yeah, Basant.
So when we are saying that Lewis will be an RNOR under the new kind of section provisions also as per section 6, and he could be RNOR under the existing provisions also, considering 182 days criteria. Then anyways, he is a salaried employee. And in this case, even though he is an RNOR under the new provisions or RNOR under the, his only taxability will be the salary which is earned in India on services rendered in India. So can we say that whatever salary he would receive for services rendered in the UK, because he is on the dual employment role, that will not be taxable?
See, we are told that the Mr. Lewis is purely looking after the global operation of the multinational company from UK or in India. When he is looking after the global operations from India, then in that case, he will be requiring to travel abroad in any case for more than 160-70 days or 182 days plus. And no amount, no piece of work for Mr. Lewis, which is purely dedicated to the local operation in India. Similarly, if he were to be employed by the UK operation or UK company, and he is required to look after the global operation, then he will be required to travel to India for the global operation as well as to other countries. And therefore, no part of the employment is treated as purely a local employment. So therefore, Section 9, which talks about services of non-resident in India, is taxable only if services are rendered in India, right? And there is a long history of what is treated as services rendered in India. So he is not rendering any services in India. Therefore, the deeming provision will not be attracted. Also, in the scope of income, he is only, if he is non-resident or even if NOR, his Indian income will be definitely taxable. Purval, does it answer your question? Hello? Hello? Am I audible?
Hello.
Yes.
Yes, very much audible.
Yes, sir.
So Purval, does this answer your question?
Yes, sir. Yes. So to summarize, what I understood is only salary with respect to his India operations would be taxable in India, and the salary which is related to his other than India operations, we can say it is not taxable in India, because under section 9(1), it is not considered as deemed to authorized in India because services were rendered outside India.
Also, if one were to consider his stay in India for more than 120 days, and we all understand that his stay in India is less than 182 days, right? We all understand that, right, from the fact.
Yes.
Now,
Now,
even if one were to try that, since he is rendering some services in India, his services should be taxable under section 9, right? That's what your proposition is. Then, there is a India UK
Correct.
Article 16 on dependent personal test. Even if he stays more than 120 days but less than 183 days, his salary will still not be taxable in India because of the India UK tax treaty, Article 16 on dependent personal test. Is that clear to you?
But in that case also, sir, I guess if on dual employment a global role, if he is receiving certain salary for services rendered in India and from India, can we
not say that this part of salary is claimed as a deduction by the Indian subsidiary, so that one of the condition of dependent personal services will not get
No, the
fulfilled,
dependent personal,
and at least that
no,
portion
no.
of the salary which is
No, Basant, the other condition is that there must be a permanent establishment, that the services salary must be borne by the permanent establishment in India of the foreign company, which is not the case here. Therefore, these arguments may not stand.
okay.
Yeah. So there are
So
remote
in this case,
chances.
the entire salary is received by him in the UK.
Yeah, will be taxable in UK according to me. Any other view you can also canvas, Mayur bhai.
Okay.
Yeah, only thing is that there could be a PE exposure if that person is Mr. Lewis is
Correct.
rendering services sitting in India for the UK company.
Very true. Very true. Okay. So
Correct.
can we go to next case study?
Thank you. Thank you, sir.
Thank you very much. Case study 2. This is a very simple case study, but what I try to cover here is that when we travel abroad for either tourism or for a business purposes, then we are stuck with the idea that yes, $250,000 is the only limit which we are able to utilize. The idea here is to give a laundry list of the various provisions of the law, FEMA, that from where you can get a foreign exchange or the foreign currency from the provisions of the different notifications under the FEMA. So we all aware of the liberalized remittance scheme and the current account transaction schedule 1, 2, and 3. And mainly travel is concerned, we are covered by the schedule 3 of the current account transactions. Now, and therefore, if we have consumed a $250,000 scheme for any other purposes under the liberalized remittance scheme, then your travel allowances will be curtailed to that level, right? So, but that is not the case according to the law. This is what I wanted to say, that what are those different allowances which are possible? One is allowances for private visit in foreign currency within the limit of 250,000. Then allowance for debit to the credit card of the person resident in India. See, up to the credit card limit, you're allowed irrespective of the liberalized remittance scheme. Then if you have RFC account, resident foreign currency account, where money is lying, which are purely originated from the foreign exchange resources of the individuals which he made or earned outside India and brought into India in the RFC account. Then there is another possibility of RFC domestic account that also can be utilized. And one can also, during the time of going out, during the travel, can take Indian rupees outside India. Also, one can make payment to Indian tour operator in rupees, Indian rupees. Also, one can take hospitality abroad without attracting the provisional FEMA. And if you are on a business tour, then of course your company can consider the travel allowances where the 250,000 limit does not apply to you. And also, if you are in your own business and if you have a branch abroad and if you are going for the purpose of the businesses of the branch which is outside India, then in such a case, you can still consider payment of expenses by the branch of Indian operations. Can we go to next slide, please? Can you go to slide number 52 now? Because from 46 to 52, I'm only explaining what is the current account transaction.
Paresh bhai,
Hi.
can I, Paresh bhai, yeah, this credit card thing, even if it is issued by Indian bank, it is fine, or it is international currency card? I mean, there is some clarification.
International, see, the current account transaction also covers the credit card issued by the international credit card agency to non-resident. In those cases, it says that the non-resident NRO or NRE account must be debited with this international credit card. So I'm not discussing that particular aspect for the purpose of the resident Indian.
Okay, but here you mean to say that if I'm using my credit card, which is an Indian rupee credit card, that limit will be
Yes.
other than the 2,50,000.
It is not covered in the liberalized remittances scheme.
Okay, so that is in addition to 250,000.
Yeah, if you see the rule 6.7 after rule 5 under the schedule 3, then that will throw light on the subject.
Okay.
That is what I explained in slide 46 to 51.
Okay.
Yeah.
Paresh bhai, I have a question. Can you hear me?
Yes, please, Nilesh bhai.
Paresh bhai, question is, you mentioned about export of INR, that the traveler can carry the Indian currency with him when he's going. Is there any limit on this, or he can carry any amount?
There is a limit of 25,000 rupees for the countries other than Nepal and Bhutan. And for Nepal and Bhutan, there is no limit except the denominations of the notes is a limit.
So only 25,000 rupees can be carried to other places.
Yeah, if you are 3 or 4 people and also sending more than 5 people, then 1.25 lakhs can be carried.
Okay, thank you.
Any other
Paresh.
questions? Yes.
Yeah, Paresh,
Yeah,
you told us. See, in case of Indian traveler, the cost of hotel, then flight charges, everything will be subsumed under 2,50,000. It is not over and above 2,50,000.
I agree with you because
because it is there in the master direction on LRS.
Yeah, I agree. It's a gray area, a little bit of, because
they were specifically given in para number 3.12.
No, I agree with you. I'm saying, but what is happening is most of the time when we pay Indian rupees, they do not make any declaration or etc. that is going to be paid out into foreign currency, unless you know that you are making payment in foreign currency through a travel agent, then only that will apply to you. Is that something which works for you, Pankaj bhai?
I think that will be very risky because you know that you are exceeding 2,50,000.
No, but if a declaration by a travel agent is not taken from you, that is going to buy foreign currency out of the money you have paid. Then,
no, but yeah, I will just tell you, because by authorized dealer, they take declaration from this traveling.
This company, so if that declaration is taken, then definitely it will form part of, because we don't know which airline you are going, which has a Indian component or a foreign component. So therefore, if a declaration is taken by the travel agent to the effect that this payment which you made will be used for the purpose of purchasing the foreign currency to remit outside India, then definitely it will be subsumed in 250,000 scheme. I agree with you.
Okay.
So, Paresh bhai, so
Yes,
just
please.
to add to that, even
Yes,
though
please.
declaration may not be taken by the tour operator,
Mhm.
at the time of making remittance, AD normally asks for traveler-wise PAN details to link it to fetters. And that is how they actually link it to a LRS limit. So
No, I'm
irrespective
saying-
of whether a declaration is taken from you or not, the AD is obliged to report
I'm
that
not-
against the respective PAN under fetters, and the LRS limit would be utilized thereunder.
No, Harshal.
Therefore, I believe that there is no way to circumvent that.
No, Harshal, I'm not asking or requesting or guiding to circumvent it. I'm saying if we do not know whether that will be used for the purchase of foreign currency or not, in those cases only it will be in addition to the LRS limit.
Ubira.
In those
I
cases
think
only.
point is well taken, that as per the law, it is our duty as a traveler not to exceed the limit.
Correct.
So, Paresh, by what you said is right in that sense. Even if they don't ask, we should be remaining within.
I'm not guiding you to circumvent.
Correct.
No, no,
Correct.
sir, I think you got me wrong. I was not on that. I was only on the
Thank you.
point that irrespective of whether you declare or not, it gets reported against your PAN. So therefore, I don't see a way out of, coming out of the 2,50,000.
Agree with you. Agree with you. Agree with you. So can we go to the next case study, please? Which is case study 3 on export of goods and services. What are we given is, question is, whether branch is required to receive export proceed in accordance with the notification 23 for all the exports made to branch outside India of an Indian exporter. The second question which we are asked is whether the company A Limited, whose branch is outside India, is required to receive net of expenses or gross amount of exports from its branch. And C, export of software with on-site development are allowed to bring in foreign exchange net of expenses on completing the project. Whether in similar manner, A Limited can also plan its transactions. So this is the pure and simple questions. We are all aware of the provisions of branch outside India by virtue of 10R and earlier circular 47 and circular 18 of 2006, that 10%, 15% and 25% and 10% each year can be remitted outside India for the maintenance of the branch. So, because those are the intended the initial expenses as well as the recurring expenses given to you by virtue of the general permission. Now, the first question which comes to my mind as a practitioner on a conceptual basis, whether branch is a entity which is a non-resident. Answer is no. We all know, right? Branch of an Indian company is a resident entity under the provisions of section 2(v) of the FEMA. So can such an activity of a branch which is a resident can be regulated by the way of circulars and etc.? Yes, answer can be found in section 6(6) of the FEMA, that it says that a branch, although is a resident entity, can be regulated by the Reserve Bank of India, and therefore such circulars are, to my mind, are valid and activities can be regulated. Now coming to the export of goods and services. If you see the definition of export of goods and services to answer this question, can you go to the next slide, please, 53. Next slide, please, Parag. Yes, yes. Can you just look at next slide, please, further, please. 55. 55, please. Sorry, what has happened? Sorry, this has come. Sorry, we have surpassed. Can you go back, please? '53, please. 53. Yes. If you see the definition of exports of goods and services, it says that taking out of India to place outside India any goods and provision of services from India to any person outside India. So therefore, when it comes to goods, it says taking out of India to place outside India. Therefore, goods have gone outside India to branch. Therefore, export of goods are considered as export of goods, although the branch is a resident entity. So it's basically an export from one entity to another entity. If you consider branch as an entity, both are resident, but it will be treated as an export because it is satisfying the definition of export to I1, to L1. Now, if you see, very interestingly, the definition of export of services, it says, provision of services from India to any person outside India. So therefore, a provision of services by an Indian company to a branch probably will not be treated as an export of services. So therefore, when we want to answer about the proceeds to be brought into India, net of the expenses or the full value is found in section, it's found in notification 9, that full value of the export should be repatriated to India. So if a provision of services does not comply with the definition of export, will you still be required to repatriate the full value of these services? That's what my poser is to the when we export or when we provide services to the branch outside India. Of course, I don't want to encourage that the net or a gross or there's no requirement to bring back the provision of services into India from branch. But the more question is probably net of expenses. Net of expenses in case of a branch could be considered. However, since the 23R provision of 23R notification 23R has regulated these activities of provision of services also without a reference to the export of services to any branch. Can a provision like this is within the parameters of the foreign exchange FEMA 1999 up to date? That's my that is what I wanted to bring about in this case studies, and therefore answers are available to you, and discussion is also available to you on this case study. So can we go to the next case study, please? And any question on this case study, please?
So, Paresh, what is your conclusion? What is your opinion? Whether a net of expenses branch can remit?
See, there are two regulations in picture. One is a notification of 23R, which talks about exports of goods and services, and which says that if it is an export of goods and services, you have to bring back the full value of the consideration. Now, the definition of export is not satisfied when you supply your services to the branch. So 23R does not apply to you. If 23R does not apply to you, then only branch regulation section 6.6 applies to you, right? Now 6.6 does not talk about any export of services to the branch, and it does not try to regulate the provision of services. However, normal activity of goods will be treated as export, therefore 23R will apply to you. And other activities of other than 23R with the Indian company is not being regulated. So my answer is, technically you are going out of 23R as well as 6.6 as well as the branch regulation, but this is how a law can be read. But since there is a provision of offsite and onsite project, and there RBI has tried to control the remittance pattern net of tax, net of expenses as well as full value, probably RBI thinks, or the law talks to you in the spirit, that such a fee is also to be brought into India at a full value and not net of expenses.
I agree with you, because there are a couple of things which we can look into this aspect. First of all, when there is a specific law to remit only for certain percentage of your turnover or net worth to the branch, okay, so that itself, suppose if it were net of revenue, then they would have provided expressly. Secondly, branch per se is not considered as a non-resident. It's a resident because it is owned and controlled by the person resident in India. But at the same time, when we look at the definition of export, it talks about only taking goods outside India. It's not talking about a resident sitting outside India.
Right.
So definitely in respect of goods, so there is no question because there will
No
be
question,
some
yes.
yeah, because there will be a lot of export declaration form and other things which one had to file.
Absolutely. Absolutely.
But I agree with you. There is a so there is some clarity required here as to whether once the branch is up and running, can it be self-sufficient in respect of whatever income it generates. Maybe some services which are rendered by a branch outside India and earned, that need not be brought to India, but vis-a-vis Indian services, perhaps they need to remit back to.
Yeah, we are only on Indian services to the branch only.
Sure, agree.
And why I'm saying that because under the export of goods and services, the 23R has attempted to regulate the services of the software companies outside India through the provision of services through branch, where India also exports or provides services to the branch. In such a scenario, they have tried to regulate. So therefore, although technically doesn't fit, they are trying to regulate. Therefore, we should not violate the spirit. That's what I want to say. But
no, suppose it's very practical. Many professionals have their branches outside India. What happens, when Indian firm renders the services to the foreign branch? So your case study is very relevant here. Thank you.
Yeah, thank you. Thank you.
Paresh bhai, there is one question I want to ask you.
Bolo Satish.
The definition of export is where goods are delivered outside India. Yes. Now, what about the case where the goods are delivered in India at the instruction of the customer, but the payment is made from overseas?
See, there is
whether the delivery within India at the instance of the foreign party, that would be considered as an export.
See, this particular aspect has been hotly debated in our FEMA SMS group. And this is not coming out of the case study, but I will answer.
Oh, then I'm sorry. And no, then you can go on if it is saving time.
Yeah, we can take it offline.
Yeah,
we can take it offline. So next case study, 3, please, 3A. Export of project. Yes, please. Yeah, wait. There has been always a debate about the transaction of export. Whether export transactions are current account transaction or a capital account transactions. The first impression of the reading is that since RBI has issued a notification of 23R and also various other memorandum of import and the project export memorandum, the first glance is that it could be a capital account transaction. However, I just wanted to tell you the group that it is a current account transaction. But the power of pronouncing the regulation is arising from section 7 of the FEMA, which allows RBI to frame regulation for the import and export of the goods, although transaction is a current account transactions. Will you all agree with me? Hello. So therefore, the project export is a typical situation where number of items of activities are difficult to be carried out with the assistance of 23R, because these are the situations which are beyond 23R. In a turnkey project of an Indian company, which is a 10 million contract in this case study, it says that part of the activities are carried out in India and part is outside India. In outside India, there is a procurement of machineries for 200,000 and also local services of 800,000. if you notice, there is 200,000 of local purchase as well as the services of 800,000 would not even be covered by the current regulation of 23R as well as the provisions of merchandise trade, because in merchandise trade you require both the leg of transaction, import as well export, both outside India without touching the shores of India, ports of India. So therefore the question arises as to how to carry out such transaction, although there are no regulation which is in the nature of 23R. Branch outside India again does not help you, because what is the normal understanding of a branch outside India is what an Indian company can do that only can be done by branch outside India based on the earlier case study. That if the full value of the export is required to be remitted, then the period of remittance is also the same which Indian company is obliged to bring in. So the branch can do only which Indian company can do. If a branch cannot borrow, so if the Indian company cannot borrow, the branch also cannot borrow. So in such cases, project exports of this nature, when branch outside India provision also cannot help you. And therefore, RBI has come out right from 1992 the provisions of the Project Exports Memorandum, PM, Project Entrepreneur Memorandum, whereby a different scheme of documentation has been prescribed. I've picked up this case study only to enlighten that how different situations of the transaction between resident and non-resident or between two residents are a real life situation which cannot be encompassed with a set of provisions either of branch outside India or by export of goods and services outside India. And therefore, a third avenues has been created by the Reserve Bank of India to address such situations. And therefore, this case study has been picked up. And what this regulations allows you is that you submit a project plan of the entire expenditure details, which could say what is your export from India to that project, which can say what is the services exported from this project, from this Indian company, which could say what is your local expenditure in the project jurisdiction, and what is your purchases outside India, and what is your purchases or export from India, which will not come back to India also. So these are the facilities provided in the kind of a documentation which is called as DPX documentation and PEC documentation, which takes care of all these situations to carry out the project, and they direct you to bring the surplus into India and after completion of the project, except the retention money which may be agreed in that particular contract. So the details are to be furnished upfront before taking up the project outside India, and all these situations are encompassed in particular provisions of PM. So can you go to next slide, please? Yes, please wait. So these are the issues: purchase of goods without import into India, purchase of overseas services, and payment through banks. How the Indian, because your banking facility is in India and project is outside India, there could be a banking facility outside India also. So how this payment will be made and what kind of a documentation is required are basically answered here in this case study. Therefore, I don't want to go through the line by line, but just to give you a flavor that how the different transaction situation can help you, although it is export of goods and services. A third avenue has been projected by Reserve Bank of India, and it is not found in any of the notifications, either 23R or branch outside India. But RBI chose to consider this outside the scope of both of these provisions, and the third provision is created by way of a circular only, and the last updated position is of 2014, and thereafter I don't think there is anything pronounced in this particular aspect. And these are created by the RBI to facilitate the turnkey project exports in various countries. And this is a big business India is having with various third world countries or poorer countries than India, whereby the government of India is sanctioning the bilateral loan with a condition that more than 60% of the exports of goods and services must be from India. So this is the purpose of creating this type of documentation and the provisions under the law in the case of the turnkey project exports. So can we go to the next slide and question, please, on this? Any question, please? So no question. We go to the next case study, which is on page 60, slide 60. These are all provision of project entrepreneur memorandum up to slide 60, so that you can peacefully study them.
Paresh bhai,
yes,
Paresh bhai, this,
yeah,
this consultancy fee payment of 110 million for infra project, it will not apply to this project export manually, project exports, because that applies to project in India, I believe. Account rules.
No, Manoj bhai, the 1 million and 10 million are referred to in Schedule 3 of the current account transaction.
Right.
So it's a current account transaction of resident in India.
Okay.
And therefore, it is in case of a remittance of these fees for projects in India, probably, you are right.
Okay.
Yeah, it's a remittance of fees.
Right, right.
So that this is a project outside India, and
exactly.
You will not come to this provision of current account transaction, because you will come to current account transaction in some situation. You will go to project export in some cases, because project exports is of course project outside India but of an Indian company, and the current account transaction is also a project of an Indian company, whether outside India or in India, may be decided from the entire fact pattern of the matter, and we can consider which particular provision we should use. Because I'll tell you, in project exports also, the feasibility study of this project starts 3 or 4 years in advance.
Okay.
So probably you can consider the current account transaction schedule 3 for the project feasibility study outside India also.
Yeah. Okay.
For such projects which will be later on taken over under the PEM method.
Okay.
I have few experiences on this subject where we have paid more than $1 million and size of the consulting.
Okay.
Under the current account transactions.
Okay.
Yeah. Because the project entrepreneur memorandum was quite far from the pre-feasibility study.
Right, right.
So in those cases, you can definitely use Schedule 3 of the current account transactions.
Okay.
And it is non-individual company cases, right?
Yeah, right. Company case.
Correct. So let us go to the case study number 4, please. Is that something, Manoj bhai, answer your question?
Project export. Can I go on?
Yeah. Okay. Yes, please. Next question.
Paresh bhai, there is one project of this medical.
Just wait. My laptop is going off. In 1 second. Just one. Sorry about this. Thank you. Yes, please. Sorry.
Shall I?
Yes, please.
Sir, there is one project which is awarded by some Africa government to some medical medical people in India. They will be doing eye surgery and eye checkup in Africa. For that, they have been awarded a say $2-3 million project, which from doctors from India will go there to Africa, and staff will also go, but they will
Right.
also require some local services. Some like item equipments will also have to be imported. So will that fall under this project export?
Yes, this will fall in project exports.
So what formalities they will have to complete for this?
So I've already given the entire documentation in this case study in response section.
Okay.
There are two types of form DPX and the other form, which is a quarterly report to be given of the project outside India. One is DPX, which is advanced documentation, giving the entire project details. It's a few pages where entire details of exports from India, local services, Indian services, and local procurement are required to be given. The profitability projection is required to be given, and surplus details are required to be given. That quarterly, what will you bring in into India? And once you file the documentation, you will fall in the project entrepreneur memorandum and not in the export of goods and services.
Right. And but the entire money has already come to India in phases, and we are keeping some amount in exchange under foreign currency account. And after that, money will be sent, whatever is required to be sent outside.
Narendra ji, if the entire money came to India, you will have a difficulty.
Okay.
Because once the money comes to India, it will be treated as an advance for export of goods and services, right?
Right.
Once it is treated as export of goods and services, you must export goods within 9 months or a 15 months period, as now extended for COVID.
Right.
So if you are not able to
goods or services, this will fall under service or goods? Because
no, it's a project actually. It's not goods and services. It's a project.
Okay.
So therefore, you will have difficulty if you are not able to complete your project in 9 months.
Right.
So please see that either it is completed, or if it is not getting completed, then you must file DPX immediately.
Sure. Thanks for guiding.
All right.
Paresh bhai,
yes, please.
Can a software development project also be treated as a project export?
No, sir. No. It is only for engineering, procurements, and services. Because this machinery was created, this avenue was created specially for turnkey project exports from India, where bilateral credit has been extended on a sovereign basis by Government of India to various countries. You know, in olden days, we used to get a circular that under the bilateral agreement, Government of India has sanctioned $20 million to Government of Senegal.
Yeah.
So these were conditional that 75% of the export will go from India. That way. All right, sir?
Okay.
Yes, please. Let us go to the case study number 4. Yes. What the question case study 4 tells us that discuss the various alternatives available to Mr. NRI in India to explore the real estate business, purchase and sale of immoral property in India. Discuss various distinguished provisions of FEMA for properties being residential house or commercial property, dealing with immoral properties and construction business. See, why I've put up this case study is for a simple reason that when we see the provision in relation to the immoral property, we are confused that what provision to apply, whether the construction FDI as stated in non-debt rules to be applied, or the provisions of Schedule 4 on a non-repatriation basis should apply, or provisions of Chapter 9 on the purchase and sale of immoral property be applied. The various advices are floating from authorized dealer and other intermediaries that yes, please you can form Indian company, buy the property, take loan from me, and pay this loan from rental collected from the tenants, and be happy about it. So such in such background, I thought we should understand as to how the provisions of FEMA are designed, that one particular compartment once you are falling, probably it will not be possible for you to go out of that compartment, because the law has been designed. If individual were to do certain transaction, then it is specified that only individual can do. If a purchase of residential and commercial house are specified in a particular provision on non-debt rules, immovable properties by individuals, then probably that individual cannot go somewhere else and find the solution which is convenient and the flexible enough for them. So therefore, I thought, let us bring out this distinction of a compartment analysis between the various provisions as to what they can permit and what they cannot permit, and probably there cannot be any overlapping between the provisions except in few cases. So that is how I thought I will bring out this particular case studies. You know that the first of all, a non-resident Indian can purchase the properties and do business also and do renting also. Now the business are available in the non-debt rules. One is on a non-repatriation basis and another on a repatriation basis. Now the repatriation basis are found in the sectoral policies, and a non-repatriation basis are found, and which is exclusively dispensation for NRIs and the OCIs. So therefore, if you want to dealing with the immovable properties, probably that is prohibited. If you are doing some business of renting, probably on a non-repatriation basis, that could be possibly done under a non-debt rules of a non-repatriation basis. And if you are, as an individual, buying the property for your bona fide use or for a rental, then probably you are falling in Chapter 9, that regulations for immovable properties, purchase and sale by NRIs and OCIs under 3 or 4 or 5 different circumstances. Can you go to the next slide, please? So go to 64, please. Slide 64. So 61, correct. Wait, please, yeah. So this is now old notification 21 has been brought into the non-debt instrument for NRIs and OCI. Also, you will find that now under the FDI conditions, sectoral policy also do permit the purchase of large mall and the commercial properties for the purpose of lease, and it will not amount to a trading of real estate activities. And in sectoral policy, there is a dispensation given to NRIs that the lock-in period of 3 years will not apply to NRIs and OCIs. Yes. So therefore, if we distinguish between the three options, then NRI and OCIs can do non-repatriation of the same activities, probably, which is can be carried out under the sectoral policy also on a repatriation basis. Earlier there was a separate activity list for the NRI and OCIs from sectoral policy, as distinguished from the sectoral policy. Now they have introduced everything in the sectoral policy and said that only lock-in period test will not apply to NRIs and OCIs. And within lock-in period, the project can be sold between two NRIs also. There is no difficulty. But repatriation can be done only in cases where trunk infrastructure is created under the sectoral policy. Whereas the non-repatriation basis, there are no such conditions. But non-repatriation basis, you can form an entity, LLP, or the private company and do the activity. Whereas when you want to acquire property, sell property in the circumstances which is stated in individual purchase and sale, then those activities cannot be carried out on a non-repatriation basis. So therefore, these three alternatives must be made out very clear in our mind so that we do not fall into any trap of violations of these provisions of the law. I think this is what I wanted to suggest by this case studies. If any question, I can take it up this question now. Can we go to case study 5, please, on slide 65? This is the case study. You know, friends, that one of the important criteria to resolve quickly the problem of resident or non-resident in office is to consider whether in what manner you can carry out your transaction so that there is a minimum documentation and regulatory requirement within the purview of the law, and quickly you can do the transaction. Just to give an example of a particular transaction, how the transaction can materially change in terms of pattern and the nature of transaction when we do it differently. I popularly give the example, which may be repeated for some of the friends, but let me just express that how that can happen. Number one is when a gift is required by a non-resident to be given away to Indian resident, there could be a two-way, at least to my mind, that you can give gift. And we all know the generally gift is a current account transaction. And if we can structure our transaction as a current account transaction, we don't need any paperwork and the long regulatory procedural aspects. Now, in this case, if I give gift from outside India by making a remittance to the Indian bank account of a resident Indian, there is no difficulty. It is a current account transaction. However, if I give same gift from an NRO account or an NRI account in India, it will take a character of a capital account transaction to my mind. However, the same is permitted under the notification 5R of the FEMA. So therefore, the same transaction can be carried out under a different pattern, and that pattern could considerably change the course of action. And therefore, an ability to convert a capital account transaction into a current account transaction by a different methodology does not violate any law. At the same time, it is safe and it is hassle-free and a less regulatory requirement in that particular transaction. And therefore, I thought I will structure this case study in order to demonstrate as to how a particular transaction which looks like a regulatory non-doable transaction and how it can still be accomplished. Here is the case study where we are told that you are a producer and UK company engaged in the production of international film, and it want to do a joint venture with the Indian party. And this joint venture is 50-50, and the total cost of production is about £1 million, where the component of the expenses are also given that 300,000 of the total cost is likely to be spent in India, and £700,000 is likely to be spent outside India from UK. And the capital of Indian company is capital and reserves is 75,000, and is contemplating the funding of its share of contribution of GBP 500,000 to part finance the film. The Indian company is seeking the immediate solution to finalize the structuring the co-production finance, as it did not have time to approach RBI for prior approval, if any. Kindly advise Indian company. So we are asked to advise the UK company and the Indian company how to carry out this job efficiently without going into a difficulty. Now, as you know, notification 120 prescribes various conditions. The number one, it is still a UK company engaged already in production of international film. So that means it is an existing UK company, and an Indian company is contemplating to invest 50% in that particular company. And therefore, to my mind, immediately the first requirement is the valuation of the UK company. The second requirement is that its capital is short of the limit which is prescribed in Regulation 6 of the Notification 120. That if I have to spend 500,000 GBP as a contribution to the UK film company, then certainly my capital requirement is at least £125,000, whereas my capital is GBP 75,000 only. Another question which comes to my mind or as a solution is that if I'm supposed to spend 300,000 in India and 700,000 in UK, can I say that 300,000 I will pay in India and therefore I don't require to send money abroad anything out of the 300,000? But 500,000 is to be spent. If 300,000 is spent in India, he still requires 200,000 to be spent. He is still required to give 350,000 to UK company because 700,000 pound is required to be spent outside India. But spending in India and spending outside India by different parties will not be able to incorporate the commercial requirement of the parties, and therefore that solution also did not work. So how to structure this transaction in order to do it efficiently? Of course, it's a webinar mode, so I don't want to ask questions to the participants. But what we suggested that both valuation as well as the prior approval, because my capital is short of the requirement, can be avoided by structuring a transaction between the UK company and Indian company, whereby Indian company will send £500,000 for purchase of Indian rights of the co-produced film, and the UK company will spend the rest by saying that they will own the rest of the right of the world, and therefore the payment made of £500,000 to a UK company under the co-production of film and retention of the rights by an Indian company will amount to an advance against the purchase of import of the rights from the UK company, and therefore that will do away with the requirement of the valuation of the UK company as well as the remittance within the parameters of Notification 120, and probably you can do the transaction very quickly. This is what I thought could be considered by the tax practitioner as a tool to convert a very simply and prima facie looking like a capital account transaction into a current account transaction to quickly provide solution within the parameters of the law and within the current account transactions law. I think that completes the
Paresh, Paresh, I have two questions to this case study.
Yes, please.
When I'm sending the money as an advance for the rights,
yes,
this goes an advance.
Yes.
And advance for services, there is a restriction of $500,000. So
correct.
Since this amount is £500,000, the bankers will not remit this money. And number two, when I'm sending this as an advance,
right,
I have to bring the services within a span of 6 months.
Correct.
And if I do not get those rights in the span of 6 months, then again another RBI compliance will start. So what is your view on this?
Correct. See, you mentioned about $500,000, right?
Yes.
Now, $500,000, and there is also a dispensation available with the bankers that $500,000 can go up to $5 million. If the Indian bank is comfortable with the Indian party in terms of the facilities which is given to them on a non-fund based facilities. That is number one. And number two is if the amount is higher than $500,000, and if UK company is able to provide the guarantees from the international bank in favor of the Indian bankers, which is contemplating in advance, then that transaction can definitely carried out. That is number one. The number two is about the import of the goods and services within 6 months from the date of making payments. Yes, that requirement is a must. And if that film cannot be produced within that time, there is a difficulty. But what we are told that the film is to be completed and released by 30th April 2020, and the finance is contemplated during the 1920. So probably that also answers your question.
Okay, so that $500,000 to 5 million, it goes only for the import of goods. For services, I don't think that limit is available. Otherwise, authorized dealers for import of goods allow that to the $5 million.
So therefore, import of film is import of a completed film probably qualify for the definition of goods according to me.
Okay.
Is that something which satisfactorily answered, Rajesh?
Yeah.
Thank you very much. Obliged. Next case study. 6, please. On 69. On slide number 69.
Parag, go to 69.
I'm on 16.
69.
That's right. I'm on 69 right now.
But I'm not able to see 69. Yes, now it is moving. It is moving now. Yes. See, this is a case study where there are 2 Indian companies. ABC and XYZ. And there is a Spanish company called LMN. The ABC and ABC are the holding and subsidiary in India. LMN is the foreign joint venture where Indian company holds, subsidiary company in India holds 77%, and 23% is held by another Singapore company, which is also a subsidiary of the Indian subsidiary company. Go to the next slide, please, which shows you the pictorial position. Parag, next slide, please. Yes, that pictorial chart. Yes. So ABC holds 74% in XYZ, and XYZ holds 77% in LMNSA, and XYZ through XYZ IIPL Singapore also holds 23% in LMNSA. The question arose as to XYZ LMNSA require funding facility outside India. And the question was, and XYZ was required to give letter of comfort, and ABC was supposed to give corporate guarantee. The question was whether ABC can give guarantee for and on behalf of LMNSA. The provisions of notification 120 and guarantee, it says, is corporate guarantee can be given for the subsidiaries or a joint venture outside India if it is a step down 1 or it is a step 1 subsidiary. So the question was whether LMNSA is step 1 subsidiary or step down subsidiary. If it is a step down subsidiary, RBI approval is required. Otherwise, RBI approval is not required. So the notification 120 is very clear. When more than one party is either investing in terms of capital, loan, or guarantees, then both parties together constitute the Indian party, and therefore LMNSA is to be treated as a first level joint venture or a subsidiary, and therefore a guarantee can be given by the ABC under the framework of notification of 120. The question can be further split in a manner that if 100% of LMNSA were to be owned by XYZ IIPL, then whether that particular guarantee is possible or not. To my mind, then it would become a second level company for the purpose of ABC giving guarantees on behalf of LMNSA to the Indian banker. And in such cases, RBI approval will be required. So this is purely a case study from the guarantee perspective given by the Indian party on behalf of the loan given to the foreign company, which is JV or WOS. Is that, of course, I have reproduced the entire provisions of the law to appreciate that how this is to be interpreted, because of the Indian party definition, and the JVN hose is to be considered only for the perspective outside India. It is not to be treated as a second or first by considering the Indian company into consideration. Indian company is to be ignored because they are both considered the Indian party for the purpose of notification 120. I think these are the issues involved in this case study, and therefore we can go to the next case study on 73. Any question on this case study, Rajesh?
Nothing. Please go ahead.
Perfect. Perfect. Then also another question arose in the case in the office of from the client, that if there are issues raised by the authorized dealer, what should we do? The authorized dealer raised an issue that no, we will not agree to this, and etc. Then we suggested that okay, if that is the issue, please request your holding company to invest into few shares of LMNSA and then provide the guarantees. So this was the last on the case studies, and now this case study is on liberalized remittance scheme overseas direct investment. This is also purely from the academic perspective, that how liberalized remittance scheme differs from the proper provisions of notification 120 for the ODIs, and what is possible under 120 and what is possible under liberalized remittance scheme. To tell you that something which is possible under liberalized remittance scheme could be not possible in 120. So that was the idea to bring out this case study. And a lot of flexibility which is available under notification 120 is not available under the liberalized remittance scheme, was also a purpose to put out this case study. Now we all know that under liberalized remittance scheme, the amount is fixed, $250,000 only. Secondly, it can only be remitted as a capital of the foreign company. A loan cannot be given, a guarantee cannot be given. The third is a foreign company which is set up under the liberalized remittance scheme cannot have a step-down subsidiary also. So these are the some of the deficiencies as compared to notification 120. And in practice, we have noticed some more difficulties, like that. In the previous case study, we have seen that ABC and XYZ both can constitute the Indian party. But whereas under the liberalized remittance scheme, if a investment is to be combined under the liberalized remittance scheme by an individual with an Indian company, then the authorized dealer and the Reserve Bank is not comfortable with such a transaction. Otherwise, one is investing under 120 and another is investing under 20A should not be difficult, should be possible, because if an Indian party is LLP as well as a company under 120, then it is possible. However, LRS and company or an LLP is mixed together does not constitute Indian party, because the definition do not include individuals as an Indian party, and LRS is a standalone code by itself, and therefore that was also a difficulty. One more difficulty we encountered during the transaction was that can another individual participate in the loan of the foreign company, because he has not made any investment, and therefore he is free to make a loan to anybody outside India, including the foreign JV or WOS of an Indian individuals. But that transaction also did not found favor with the regulator and the AD bank. And so therefore, these were the difficulties which were known in the law as well as unknown from the law perspective. The only the plus point we found probably by all of us is in the area of a portfolio investment. That the notification 120 clearly says that the law applies to the overseas direct investment by purchase of shares and subscription of the share, but does not include the portfolio investment. So when the law says that it does not include portfolio investment, so that does it mean portfolio investment can be made or portfolio investment cannot be made? According to me, because 120 excludes portfolio investment to be considered for the purpose of permissible capital account transaction, the portfolio investment will not be covered for the purpose of ODI under 120, except the listed company share, which is allowed to the some corporates in India. So individual will not be permitted under 120 in any case. So therefore, the question came up whether the portfolio investment can be made under the liberalized remittance scheme otherwise than 120 and otherwise than the regulation 20A. The plausible answer was found in favor of the remitter, that yes, probably if you don't want to involve the Schedule 5 regulation 20A and notification 120, probably portfolio investment can be made under the liberalized remittance scheme outside the scope of 120. That is what the differentiation between the two schemes and the practical issues which we encountered. And the floor is open for question on this subject if there is any question, and otherwise we go to the next case study.
Sir, Himang here, sir.
Yes,
I have one question, sir. So under LRS, the remittance was made in 2013. So and that was done. LRS was done into a Singapore account, and
yes.
then from Singapore account, this amount was utilized to subscribe to shares in Dubai company. So, sir, my question is whether ODI is required in such scenario.
Again, sorry, sir, I missed you.
In 2013, under LRS, I made, so I remitted some funds into my Singapore account, Singapore bank account. It was purely US dollar account.
Right.
And from that Singapore US dollar account, in 2020, I got an opportunity. So I invested in forming a company in Dubai. So whether now am I supposed to file a form ODI? Because practically when we approach SDFC Bank, so they are having no clue. Our bankers are SDFC Bank.
Okay, and this remittance and the formation of company was made prior to 5th August 2013 or after that?
So it was after 5th August 2013. It was under this LRS. Okay. And it was in the Singapore account in my US dollar account.
See, the fundamental principle of the FEMA is what is directly not possible is indirectly not possible. Do you agree with me?
Yes, sir.
So by using the remittance scheme and keeping the money in bank account, you have invested in the foreign company, right?
Yes, sir. Yes,
so,
yes.
Directly you could not do that, right?
Yeah, I could not do that.
ODI and etc., right?
Yeah.
So you have given your answer, boss.
Okay, sir. Thank you.
You got the answer?
Yeah. So basically, it has to be routed through authorized dealer only, and the remittance has to be from India only. If I have to form a company, means subscribe to shares of a company in Dubai or anywhere.
Correct.
Yeah. Okay,
and
sir.
file form ODI basically.
Yes, sir. Okay. Thank you.
Yeah. Can we go to 7A case study on slide 85, please? See, on slide 85, what I'm covering is certain practical issues arising of the remittance under this scheme, basically.
Is slide 85 visible?
Yes. It is visible. Okay. The first issue is it possible to make payment for incorporation of a foreign company to service provider before the incorporation? Is purchase of minimum shares from a company agent treated as a purchase of shares of an existing company? Portfolio investment is permitted under LRS, and such a combination of individual with company is in order. So last two questions we have already answered, I believe. So the first two questions, is it possible to make a payment for incorporation of a foreign company to service provider before the incorporation? If you treat this as an expenditure of a holding company in India, because the company is still not in existence, probably these expenses can be paid by an Indian company to a service provider as a current account transaction, being a shareholder expenses before capitalizing the company. This is the answer. And if the authorized do not agree with such things, then there are difficulties, right? Then in those cases, probably agent can purchase the shares without any obligation on your part to purchase those shares on that date. But you can then definitely purchase these shares from the agent, and it is an existing company, and therefore the valuation issue may or may not arise if the stand is taken by the authorized dealer that there are no activities, but the foreign agent has formed this company as a nominee of the Indian party. And if the purchase of share, the formation of company and the purchase of share is in the same year, probably there won't be any difficulty. Otherwise, if it's a different year, we will have to create a liability to purchase these shares, and therefore, if that transaction is not intimated, then there is a difficulty, because certain situation, ODI is also required to be filed without remittances now. Earlier, it was hard to find out whether the ODI is required to be filed without making any remittance. But now, in the new avatar of Form ODI, you are required to file ODI even if you create certain liabilities abroad. So therefore, I think that is the response to the second query on this particular slide 85. And we go to the next case study, please, which is on page number 86.
If you don't mind, there's one question from Shah.
Yes, please.
And he's asking whether an individual can invest in a...
Sir, that is already answered. I am Hemangsha only. I just asked online. Yeah, sir. Thank you, sir.
Sure.
Thank you very much. Yeah.
Let us go to the case study number 7B on slide 87. Yes. This probably is also similar to what we have discussed. So probably this is also under that the company incorporated in Singapore on 1st October 11 upon incorporation, whether there is any obligation. So that I think we have answered on recognition of the overseas subsidiary, whether required to be done or not if the remittance is not made. And then we go to the next case study, which is on C, right? Yes. This is also a case study revolving around the ODI, that a normal marketing company outside India, in the nature of facility management, traveling, payments made on behalf of overseas venture to its supplier, etc. See, when you are forming a marketing subsidiaries outside India, your branch route is not applicable to you, but only ODI route is applicable to you. But what happens? The certain expenses are done by Indian company on behalf of the foreign company overseas, and let's say traveling expenses, the normal facility management expenses in India, which are in the temporary nature. So the question is whether while making such payment, whether you are required to file Form ODI or not, and whether it is a capital account transaction or a current account transaction. Kindly discuss. To my mind, if these expenses are made out and if they are settled within 12 months from the time it is spent, then probably it will fit in the definition of current account transaction in the nature of short-term credit given to the overseas subsidiary or a joint venture. However, if it is exceeding 12 months, it will not fit in the definition of capital account transaction, and therefore it will come out for reporting by or Form ODI by saying that this amount is spent on behalf of the foreign company without making any remittance. And therefore, that is how this question can be addressed. We can go to the next case study.
Paresh bhai,
Yes, please.
one question here. So,
Yes, go ahead.
is there any possibility of application of section 3B to case study 7C?
Not really.
So how do we actually come out of it?
Not really, because in a short-term credit facilities will not include only cross-border transaction, isn't it? Let's say if it is a cross-border transaction, then definitely section 3 will be attracted.
Right.
But I am giving a short-term credit facility to my overseas subsidiary in India. And I am governed by the regulation which I am properly reporting.
Sir, I believe in your case study, it is payments to third parties, right?
Payment to third parties, but on behalf of my foreign subsidiary.
Yes, yes.
In India.
Yeah, in India.
Yeah.
But still, it is 3B, no, sir? 3B should cover, no?
Only.
So probably Arshal is asking that it is without corresponding inward remittance, am I right, Arshal?
No, that is 3C, Mayur bhai. I am talking about 3B. That no person shall make a payment for or to the credit of a person resident outside India.
Of course, to the extent it is permitted, it is allowed, right?
Yes, sir. So where is the express permission for this under law?
Short-term credit facilities.
That is purely a current account transaction definition.
Yeah. Look at the item number 1 in the definition of current account transactions.
Yeah, right.
But
Yeah,
just because it is a current account transaction simply, do you come out of section 3?
This is the current account transaction of a resident in India, right?
Yeah,
which are not specified in any of the schedule of ABC, right?
Yeah, he's right. He's saved otherwise provided, no? Section 3 also.
Correct.
Okay. Yes, yes. So you mean to say any current account transaction which is actually permissible will come out of section 3?
Yes.
Of course.
Yes.
Okay. So I actually held the same view, but I have come across some compounding orders. Probably, I can discuss with you offline.
Sure, definitely. Thank you, Arshal, for agreeing with me.
Yeah.
It's a good point, Paresh bhai, you made out.
Thank you very much, sir. Next case study, please. Next case study is on page number.
This is on page 91.
Yes.
Is it visible?
Yes.
Can you see page 9?
Yes,
okay.
Yes. What it say this case study says is that we are an export house, and in this export house, if we are a proprietary concern and there are huge outstanding is remaining, then whether can we solve this problem by utilizing notification 120 in some manner? And if answer is so, then whether the proprietary concern is advisable or the company is advisable. That was the question. Now the answer can be attempted in following manner, that when we look at the notification 120, regulation 11, it allows you to capitalize the export of goods and services of some nature to the foreign subsidiary or a joint venture. So you need not consider the receipt of payments against this particular exports to the foreign company. So the answer is found that yes, you can capitalize the export of goods and services to the extent whatever working capital is required by you abroad. The second question was whether a company is good or a proprietary concern is good. The answer is very simple, that the company is preferable, because if a proprietary concern is formed, then definitely you require a RBI prior approval for doing such transaction. And this is what the answer, plausible answer I thought can be given for these case studies. Next case study, please. Is on page number 96. Yes, 96. It's 91 now. So bring it to 96.
So I'm on 96, there's certain time lag.
This is correct. Yeah. So now we are at 7:56. How much time we have, Mayur? We have 10 case studies. We are on.
Rajesh, Paresh bhai. After this case study, we will conclude. Then we will keep another meeting at a convenient date.
Okay, perfect.
It's
So,
8 p.m. Yeah.
This is a very important case study.
Yes.
Real life case study. Very interesting case study. So we may extend 5-7 minutes more. That's all. XYZ, an international company limited, is a company incorporated in UAE and has factories in Hamaria, Frizon, and Fujairah. It is into a large-scale EPC contract for more than 2 decades and specializes in oil and gas sector. Recently, it is in final negotiation with an Indian company, a private limited company, for an EPC contract involving various aspects of the transaction of a $30 million transaction, where there was a 10% advance for the goods and services, and there was a milestone payments in next 6 months time, and there was services also. So the question arose as to how to make a $30 million payment in advance, because within 6 months, 30 million payment to be made in advance has a difficulty, because if advance is to be made, then it is an advance against the import of the goods and services. The import of the goods services maximum payment we saw while we were deliberating with the Rajesh, that 5 million for goods and services, for goods, and a half a million for services. Beyond that, we cannot do. So most of the expenses to be incurred was in Sharjah, outside India, and 80% of the expenses were attributed to the material which is produced outside India, and about 10 to 20% was only for services. So how to structure such a transaction? Because the foreign company party did not want to come into India and set up the project offices. So it is given that the foreign party has no loan facilities in India, is not intending to take any loans from anybody. And the transaction was to be signed in a matter of 30 days or so. Also, the foreign company did not want any payment in the Indian rupees also, because the project office being in India, the transaction is carried out in Indian rupees. There is a lot of difficulties in making payments abroad by spending foreign exchange losses and etc. So the question arose as to how to structure this transaction in the best manner, because if there are no banking facilities and project is not approved by any statutory authority in India, that project offices are not under the automatic route basically. So you require a prior approval for non-resident to consider the project approval. So it takes time, and therefore you're not able to enter into a transaction. You cannot give more than $5.5 million, more than $5.5 million, unless there is a guarantees given by the non-resident of an international bank for an advance higher than the $5 million, which non-resident is not obliged to consider. Also, we explored whether the Indian resident can form a project office outside India to only procure these goods, so that it can send money for the project outside India under the either DPC scheme or the branch outside India. But that also did not work, because this was not a project outside India. This was a project in India, because it's an import of goods and services, and therefore that was also not viable. And the branch also was not viable, because branch will not allow them to remit large amount outside India for the purpose of procurement of the goods, which is to be ultimately imported into India. So we came out with the conclusion that what is the best solution is that the Indian company can approach RBI quickly by saying that you have to make larger payment without the uh, guarantee of the international bank, and the also also the other aspect was the advance which was to be given, and the export or the import which could arise may exceed the 6 months time. On both these criteria, we advised the Indian company. The client was foreign client, but we then has to come up with the best solution. And the Indian company should go to RBI by saying that we have to pay more advance than the $5 million, because there are no banking facilities, and large payment are going for the procurement of the goods, which is 80%, and but which is a milestone payments. And milestone payments are definitely secured payment, because the goods are lying in the custody of the foreign customer, which can be extended to the Indian party by virtue of title to the goods. So considering all this possibility, we advise Indian company that please approach RBI immediately, so that 6 months timeline can be avoided, and more than 5 million payment can also be avoided. And that was the best way to provide a solution in this large transaction with lots of ifs and buts. Also, one more issue was the project office is situated in India, where the civil work and etc. is only 10-15 days of travel by the foreign company. And if they were to have a project office in India, then it could have a exposure to of the PE in India, and which will probably have a large exposure of 40% plus taxes for the foreign company, and which was really a very large risk, and which was a moot point in convincing the Indian company that you should go for the approval and not the project office outside India. Party should go to the Reserve Bank of India. I think that was the matter which we discussed in this transaction, and that is what the solution we provided. With this, thank you very much for the members and the friends for patient hearing. And if there are any questions, consider with the permission.
Sir, this is Sridhar here from Chennai. Can I have one question, sir?
Yes, Sridhar.
Sir, I'm a practicing company secretary from Chennai.
Yeah, I met you in Chennai.
Yeah. Oh, thank you so much, sir. You remember me.
Yes.
Thank you. That was in the CA Institute for a 2-day seminar.
Yes.
I was there.
Yes.
Sir, see, I had made an investment in a foreign company, and I got the UIN number for an ODI that was made.
Correct.
That foreign company had merged with an Indian listed company in India.
Okay.
A cross-border merger.
Correct.
That means the shares have been given through the scheme. The shares have been given not to the foreign company, but as a promoter, it has been given to me, because me and my partner are the two shareholders or two promoters of the foreign company.
Right.
So the Indian listed company gave us the shares rather than giving the shares to the foreign company, because the foreign partnership has been wound up now.
Correct.
Now the ODI, the UIN number that has been allotted for the ODI is in limbo. Do you advise us to go to state by RBI and cancel the UIN number, or how is it, sir? Because as long as the UIN number is there, I am obliged to file the and other things, whereas the company itself is not in the overseas company itself is not in existence.
See, what has happened here is that the overseas company has been converted into branch, basically, because there are assets of the overseas company, right?
No, there are no assets, sir. Everything has been sold. There's no assets.
If it is wound up, yes, and all assets are brought into India, perfectly all right. Otherwise, normally conversion of company into branch also is done like this by merging with the Indian company. However, in your case study, in your question, you are the shareholder of an Indian company, right?
Correct. It's a listed company.
Right. And you are given the shares of which company?
Of the Indian entity.
Which is the foreign company is merged in Indian company, and you are given shares of Indian company, right?
Exactly.
So basically, it's a merger of a foreign company in India, and cross-border merger is falling within the parameters of the ODI guideline. And therefore, if you fall within the ODI guideline, then the shares can be given to you without any difficulties, and UIN number will be cancelled by the Indian company.
Is it automatic cancellation, or should I make an application, sir? That is the question. UIN, they have not cancelled it.
No, see, foreign company is liquidated, right?
Yes.
Assets are brought into India, right?
Yes.
So disinvestment report is filed.
Yes.
When disinvestment report is filed, they have to take into consideration, isn't it?
Okay. So what will be the date of disinvestment, sir? Will it be the date of the order of the NCLT, or will it be the date of psych-off of the company in the overseas jurisdiction?
See,
What will be the date of liquidation?
in the reality, the liquidation process goes long.
Yeah.
Not that it is overnight.
Yeah, everything is over, sir. It is a transaction which everything was completed in 2018.
I'm giving you a practical circumstances.
Yeah.
But when you think that you want to liquidate the overseas company, from the time you think it will take 6 months to liquidate completely. Right?
Okay.
Now, when you pass a resolution to liquidate the foreign company,
okay,
your obligation to report the transaction starts.
Correct.
Correct. Now, and within 90 days, you have to bring back the entire proceeds of a liquidation, right?
Correct.
So therefore, if you inform now and if you breach the line of 90 days, you may have to approach Reserve Bank of India again.
Okay. Okay.
So you must work backward so that your disinvestment report is filed in accordance with the timeline of liquidating all the assets and liabilities of the overseas company.
Okay.
And once you file the liquidation report, bringing everything in 90 days, the unique identification number has to be cancelled.
Okay, sir. I got it. I got it, sir. I got it.
Hello.
I got it. I'll approach AD banker and push it on, sir.
And now you are owning the Indian company shares, and therefore there is no question of any reporting requirement under the
Exactly.
ODI for the new identification number.
Exactly, sir.
All right.
Exactly.
Does it answer your question?
Yes, sir. It answers my question. The only thing is the whole transaction have been completed and it was not reported within 90 days. One. Number two is the question is when does the 90-day clock starts? Whether it is from the date on which the Indian NCLT gave us the order, or is it the date on which the overseas company struck off the name of the company from its register? So that's the question which the State Bank is now asking us.
Yeah, I'll tell you. Different scenarios. There may be a transaction of sale of shares of an overseas company to a non-resident. Now there, let's say the payment guideline, if you enter into a sell purchase agreement, then that is the date of sell purchase agreement is the date of liquidation, because the process starts from there and you must report the transaction and the proceed must be brought in 90 days. If you are not bringing the proceed within the timeline, you must get a prior approval from the Reserve Bank of India.
Oh, okay.
Very simple. Very simple answer.
Hello.
Yes, please.
Sir, my name is Neil Shah.
Yeah, Neil.
Sir, can partly paid up equity investment received in private limited company on non-repatriation basis from NRI can be forfeited without RBI approval?
Yes, because on a non-repatriation basis, you are governed by the company law only, not by FEMA.
Okay. Okay. Thank you, sir.
Parag will give a interim vote of thanks to Paresh bhai.
Sure, absolutely.
Thank you, sir. Thank you so much.
Paresh bhai, thank you so much once again for sharing your knowledge and enlightening us. It was indeed a pleasure having you. And as Kirit bhai mentioned, we would love to have you once again, for the remaining case studies, and if possible, many more in future.
And I also would like to thank BCA once again for giving me this opportunity. And also thank you to my office, Mitali Shah, Nirav Panchamiya, and my friend Varsha for allowing me to share some of the case studies from her perspective also. Thank you very much.
Thank you, sir.
One announcement, we have arranged online FEMA refresher course starting from Monday 27th. So I invite all of you to join that, and we'll be sharing the details on WhatsApp group. If anyone wants to know further about it, because there are different 5 sessions are there and 5 different Zoom IDs are there for joining that. So please watch out for that announcement. It was already there. If any case, if somebody doesn't get it, contact any of the conveners, Rajesh, Shah, Kirit, Dedia or Parag, and you will get all the information. Thank you very much, Paresh bhai. Thank you for joining and sharing your valuable knowledge.
Thank you, sir. Bye-bye.
Thank you, sir. Thank you.